Gold gets painted with a double top, and now it goes down $100 in 2 days as everybody sees the double top and says, "Oh, I got to get out." Silver runs up. They paint a reversal candle. False breakout above 30 is what they're trying to do. They hike margins to pull this off. All of it, it's just crap.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Craig Hemke, aka Turd Ferguson, joins us today. Turd Ferguson is not a soothsayer or psychic or a witch, and after all these years, he simply has a decent handle on the gold and silver markets. Along with that, he is one of the best out there that keeps an eye on the COMEX and calls it how he sees it. And we're delighted to have Craig join us once again today. It's time to saddle up and silver up for Craig Hemke. Craig, welcome back to SBTV. How are you doing?
Patrick, it's always so good to see you. We've sure seen a lot in the last several years since we've known each other, and man, it's only seeming to get more interesting by the day here in 2024.
Absolutely. Craig, I saw a recent tweet. You say you're not a soothsayer or anything like that, but I don't know about this anymore. Saw a recent tweet. You tweeted out, given the recent surge in contract open interest, volatility, and price, expect a CME margin hike on silver. You called it. Tell me about this.
Oh, Patrick. It says right there on the old little thing there, established in 2010. And I've seen some stuff over the 14 or 15 years. And part of that is there's a playbook for controlling price. Because remember, on the COMEX, the amount of supply, mine supply, that the commercials or the banks or the producer, however you want to put them all together, are short, is outrageous. I mean, it's like 5 months worth of mine supply. And that's unusual. You don't find that. I mean, it's like kind of like half that in gold, and all the other commodities, it's, this little tiny amounts. So when silver really takes off, the banks, and what I'm talking about, like whether it's JP Morgan or Citigroup or HSBC or, you go down the list, they get in a bind. And as price is going higher, like it was late in the week of the 17th and early in the week of the 20th, all their shorts are underwater, and it puts them in quite a bind. And so what you typically get is a pattern that's now unfolding. Early in the week of the 20th, after closing at a breakout high, you got a lot of momentum. You got a lot of new spec hedge fund money that came rushing in. Open interest on the COMEX rose by 14,000 contracts, or about 6 or 7% in a couple of days. Mad rush of speculator money. And anybody can go back and look at the chart we were watching at the time. Price was capped in off hours, whether it was 5 in the morning Monday, whether it was 4 in the afternoon New York time later on Monday, whether it was again overnight about 10 o'clock Eastern on Tuesday. You do that because on off hours, the bid stacks are smaller. It's a lot easier to control the price when volume is light. The bid and the offer stacks are small. And you get you defeat all of that open interest coming in, and eventually price, you run out of momentum and it rolls over. And it's then that you get the margin hikes. Okay. That tweet you mentioned was after watching this happen in copper on about a 24-hour earlier cycle. Copper ran up, got above $10,000 a ton in London back in April. It was kind of a psychological resistance, kind of hung around there for a couple of weeks, and then finally used that level of support and went to $11,000 a ton. Now keep in mind that Goldman Sachs still forecasting $12,000 a ton, Patrick. So, I mean, we're not done with this trade, and we should talk about it. Nonetheless, same thing, kind of rolls over, runs out of gas. CME hikes copper margins 3 times in 5 days. And all of a sudden, COMEX copper goes from a high of like 520 down to 480. Gosh, Imagine that. So, same trick now being played in silver. We saw it. It's exactly what they did in 2011, where they hiked 5 times in 9 days. They're now, here they come after the drop on Wednesday, the 22nd, with the margin hike 4 hours after I tweeted, you better be on the lookout for one. And then what that does is it forces liquidations. All that open interest that came rushing in earlier in the week, pushing price up to 32.50. Well, now not only is it underwater because of the decline, as momentum ran out, but now you're getting margin calls. I'll just sell it. And then you get further on selling, and by Thursday, we're back to 30. And so it's just, again, I'm sorry, Patrick, it's a long answer, but this is how it works. That's why I always get a chuckle. I've been doing this for a long time now. I'm like considered like the old fart. I'm like the old wise maven, and I am getting old. But there are a lot of newer people to this game. This how this works that I see on X, and they all say, "Oh yeah, once we get through 30, silver's going right to 50." And I'm like, yeah, no, it doesn't work that way. Or once gold gets through 2,300, it's going to 3,000. It doesn't work that way. You get this ebb and flow, 2 steps forward and 1 step back. And that's what we're now experiencing it once again.
Yeah, no, I appreciate that answer. I think a lot of us we're trying to figure this out and taking a look at it and see what's going on, and especially with the new guys. You mentioned the new people that have come into silver, and one thing that popped up in my mind was how would you compare or maybe contrast the last time we saw silver at these price levels, the $30 range? At that time, of course, was during the Wall Street silver movement some 3 years ago. But what similarities do you see, or what differences do you see with that time?
Well, it's very similar. That day with the silver squeeze back on February the 1st of 2021, I think silver got to 30.20 was a high. And then we had the famous, Rostam Benham, the head of the CFTC, talking about how we had to tamp down the price. Why? What business is that of yours? But again, when the big market making banks are net short, like right now, 400 million ounces. Well, every dollar that it goes up is another $400 million in paper losses. Not all constant, it's not all in one position. I'm talking net of a group, but nonetheless, another $5, that's $2 billion in losses. So to keep the market orderly, we got to tamp it down. You can see this then. This is why potentially Friday the 17th was such a big deal. Because after the run up with COVID in the spring of 2020, silver went up to 28.29. And then it was, again, inclusive of that silver squeeze, in early February 2021, 29 was like a hard cap. There were 4 occasions between July of 2020 and July of 2021 where the spot price of silver closed above 29. And on all four, I invite anybody to go look this up. I'm not just making this stuff up. On all 4 of those days, the very next day, a huge red candle and a drop of about $1. Okay, so somebody knew, look, we cannot afford a breakout. All right. So fast forward to, really the week of what, the 13th. And all of a sudden, silver is just beginning to soar. It gets through 29, goes up to 30, gets through 30. And on the final day, Friday the 17th, boom, just blast forward. It looks almost as if pricing control is moving to Shanghai because Shanghai is going up 5, 6, 8% a day and is trading at $35 an ounce. And COMEX is down here at 29. Well, at some point, do the banks have to let price go? Because if that arbitrage gets too wide, they're going to, the COMEX vaults, even if you count it all up and assume it's all there, is only 270 or 80 million ounces. Well, that can get drained pretty quickly if the arbitrage becomes profitable enough. So they have to let the price go up, right? I mean, there was maybe a reason why the heads of the 4 major bullion banks all appeared in Shanghai to meet with the Shanghai Gold Exchange people in late March and April. But maybe they're worried about this. Anyway, so you get this pop up through 30. We finished Friday the 17th at 31 and a quarter. It's a clear breakout. Actually, by the time the Globex trading ended at 5 o'clock Eastern that day, we were 31.77. Clear breakout. And again, at that point, price management mode kicks in, and that's now what we've seen the following week. Again, going forward, the key thing will be, Patrick, to what extent does a physical offtake market, well, within China, um, begin to now drive price? And does the COMEX have to become reactionary to that rather than proactive with their margin hikes and all the other crap games that they've played for decades?
If you're enjoying this interview with Craig Hemke and I, please consider subscribing to our YouTube channel. And did you know that at Silver Bullion, there are 6 different types of accounts to fit your needs? To find out more, go to www.silverbullion.com.sg, click on the Signups tab, and choose from these 6 types of accounts. Or email me, Patrick at silverbullion.com.sg, and I'll help to get you started. Craig, with gold hitting all-time highs, copper hitting all-time highs, why why silver? I mean, why is silver the odd man out and so far behind its all-time high?
Yeah. Um, you know, how do I start this answer? There was a talk when copper was rolling up through $5 a pound last week. That suddenly, the COMEX, major short squeeze and all this. And maybe there was for a day, but really the pricing power in copper's in London on the LME, where it's priced by the ton. Okay. And that's an actual physical offtake. COMEX has like 20,000 metric tons in 6 different vaults geographically around the country, around the US. 20,000 tons is, believe me, it's nothing. I mean, it's next to nothing. So this idea that they were going to sail ships, divert ships full of copper concentrate and copper stuff to these COMEX vaults is just not. It's written by people that don't know what they're talking about. But copper has more in common with silver now than silver has with gold. I mean, maybe one day again, silver will be a monetary metal. There's an investment component. I've got physical silver that I own as an investment that you don't really have with copper. But in terms of industrial and electrical demand, silver now has more in common with copper than it has with gold. And I mean, it's a great conductor of electricity. And so that is why, besides a little bit of investment demand, the total combined silver supply deficit from 2001 through 2024 is going to be like 700 million ounces. Okay. Now there's people that pretend to be experts that say, oh, well, that's because there's all kinds of silver laying around. It's not a problem. You can always melt down grandma's teacups, or place settings and her candlesticks. Okay. But the problem here is silver, again, is in short physical supply in a market that's in the primary pricing scheme is off of derivatives and leverage. So what happens when the silver runs out? I'm going to can I just keep going for a second? I don't mean to.
No. Go ahead. Go ahead.
Like filibuster this whole thing. Okay. Let's talk. I want to talk. I've wanted all week to talk about copper, so I'm finally going to be able to do it. I have believed for 15 years that the supply of physical metal, gold and silver, is kind of just in time, hand to mouth, if you will. The banks that operate in London, remember Nowak, the guy from JP Morgan that's now currently in jail for price manipulation? He was the head of the JP Morgan Global Precious Metals desk, running paper price, but he was also on the board of the LBMA in London. Okay. So think about that as like a hand and glove. Okay. So the banks manage this price. They know where the orders are. They know where the physical orders are. They know where the physical supply is. They manage the price of gold and silver on a daily basis, really, to a level that they can flow metal. And again, almost like a just-in-time delivery. There's not like this massive stack of gold that they can constantly just be dumping, right? They'll raid. This is why the ETFs have been going down, because the banks, the bullion banks, are the authorized participants, the only entities that are able to take metal out. Okay, so think of it as just, and I've always thought that the case. Well, maybe that's what's going on now in copper, Patrick. And I'll give you 2 things that have happened in the last 6 months, and all of a sudden, oh my God, are we running out of copper? When I wrote my annual forecast a year and a half ago in January 2023. I had a big section on copper because Goldman Sachs at that time was saying that above ground copper supplies may be non existent and extinct by August of last year. Okay, well, that didn't happen. Okay, maybe they're just early because now 8 months later, 8, 9 months later, we're talking about that, right? The ships having to be diverted to New York, and this kind of crapola. Okay. Goldman Sachs still forecasting $12,000 a metric ton for copper in London because of these supply constraints. Again, living hand to mouth just in time. Two things have happened that have upset the apple cart. One, back in April, the US and UK, as a sanction against Russia, said the London LME and the COMEX can no longer take Russian copper, aluminum, tin, and one nickel, maybe. So now you're removing a supplier of copper to the exchange. That's a big deal. But even to the extent of this just-in-time delivery, do you remember late last year the news about Panama shutting down the Cobre Panama copper mine? Do you remember hearing? Does that ring a bell? Okay. First Quantum Minerals operates that mine. It's the largest open pit copper mine in the world. 1.5% of global copper supply comes out of that mine. 350,000 metric tons a year. Okay. So when I mentioned the COMEX only having 20,000 metric tons, okay, 350,000 metric tons of copper production was taken offline with that one mine that is still offline because Panama wants to negotiate a better deal. So between that and the Russian thing, are we suddenly out of copper? I mean, maybe. So anyway, the reason I tell everybody all of this, we're watching the same old shenanigans, right? Gold gets painted with a double top, and now it goes down $100 in 2 days as everybody sees the double top and says, I got to get out. I'm good for a while. Silver runs up. They paint a reversal candle, false breakout above 30 is what they're trying to do. They hike margins to pull this off. All of it, it's just crap. Because at the end of the day, and we've been talking about this for 15 years, without the physical metal, that whole system blows up. That's why you don't want it in unallocated. You don't want your gold and silver in an unallocated account. You don't want it in ETF. You've got to actually buy it and own it and take delivery. And one day, and maybe it's beginning to shift, the physical market begins to actually assume pricing control. So anyway, that's a really long answer. But what I wanted to do was kind of lay out this whole copper situation for people so that they can then translate that to silver. And if copper is in a real problem, well, they're just not going to be able to keep silver down. They're just not.
You're saying like how that one day, maybe that one day is here where physical copper, physical silver will start to control the price of silver. Is that what we may be seeing with the Shanghai Futures Exchange, where we are seeing that price difference between COMEX and over in China?
Yeah. Now, look, I far from being an expert on any of this, but I went, go online. Anybody can pull this up. I remember when the Shanghai Gold Exchange and the Shanghai Futures Exchange were set up in 2013. You couldn't. It was nice. It was great, physical and all that kind of stuff. And there was a crude to gold trade and all this kind of stuff, but they were set up with very strict delivery rules. And the most recent document I could find was from 2019. You can take delivery in Shanghai of physical silver, platinum too, for that matter, as long as it doesn't leave China. And again, anybody can find this document. I had it talking about on my podcast back a couple of days ago. No international country, company, or individual can take physical silver delivery out of China. So that's something, what's going on there? That's something for people they got to think about. Nonetheless, that is a physical deliverable contract. So when you see China, and then you got, the VAT tax and all that kind of stuff. But when there is as we speak, about a $4 premium, maybe slightly more, between the dollar price of silver in China versus what they're pretending the price is through trading of derivatives in New York, well, that's an arbitrage possibility. Okay, now, yeah, you got export and import rules. You got all this other crapola that I guess at $5 an ounce is not enough to make it worthwhile to buy, and can you even get silver off COMEX anyway? But nonetheless, you'd have to buy in New York and sell in Shanghai, and then you got to facilitate moving that silver, and that means you got to actually believe you can get it out of New York. Otherwise, you're just going to be short in Shanghai, and who wants any part of that, right? If you can't deliver, so I'm just not sure how quickly this transition can move from New York being the price maker to this physical trade in Shanghai for all these different reasons being the price maker. But you can clearly see the impact, and it is definitely is all part of what popped silver up on the 17th all the way up, to 32, almost $33 an ounce before the shenanigans took over and drove it back down. It's coming. It's a process. It's going to take a while.
Yeah, gonna take a while to agree because with the demand for silver becoming more widely known, especially with solar panels, photovoltaics becoming more and more
Yeah.
mainstream now. How long can let's just call it the alleged silver shenanigans that we see with the COMEX and others continue? And you're thinking it's going to be tied in with how long they can get physical supply?
It will continue until it can't. I mean, I don't mean to give you, it's like, what's the actual price? I can't tell you that either. That they will continue to play this game thinking that they can continue to make tomorrow like yesterday, keep price under 30 where they've got it under control, as long as they can. The key is them making money. I get this all the time from people that say, well, if gold's manipulated, then how come it's gone from 400 to 2,400? Have you ever noticed the years where it goes up 25%? I can count on one finger. Okay. Gold goes up 10% a year, has gone up 10 or 11% every year since the year 2000. That is manageable. Okay. The banks that make the market and are responsible for this just in time delivery and everything else, they can make money at that. That's fine. And they do. Well, they can't wait. 50% in a year would be catastrophic. And that's what happens in silver. There are, like I said, 140, 150 days of global mine supply that they're collectively short. And if the price just runs away from them, what are they going to do? Here comes, look, I've been going on and on and on. But I don't know if there's a whole lot of people left that remember 2011 as vividly as I do. Okay, so not to make it sound like I'm some global font of knowledge, but I remember how that all went down. And silver was $18 in November of 2010, and 6 months later it was 48. And we suspected at the time there was a massive commercial short squeeze. Everybody figured it was JP Morgan. Bart Chilton, 3 weeks before his death, gives an interview like a deathbed confession, confirming that that was the case, that they handed off Bear Stearns' short position to JP Morgan in 2000 and whatever that was, 8, under the assumption that they would get rid of it. JP Morgan looked at it and said, we can make too much money doing this. And so they never did. And then they had this massive short squeeze, and you could see it in the COT reports all through March and April. It wasn't a rush of speculators. It was JP Morgan getting squeezed. They didn't even have a vault. So then what happens? 5 rate hikes in 9 days in May. They smashed, and there's all that is history. And also JP Morgan gets rubber stamped for a COMEX vault. They didn't even have one. Over the next 5 years, they accumulate about 150 million ounces. If you contact the CFTC now and you say, hey, how come, X and such bank is in excess of position limits, when they're delivering 4,000 contracts in a month? That's bona fide hedging. Well, how do you know it's bona fide? Well, look at our vault. We've got 150 million ounces now. That's 30,000 shorts you can lay on at any time. Anyway, I'm really going off into the weeds here. What I'm trying to explain, I guess, is that the shenanigans, the control of the price, management of the price will continue until it doesn't. And Patrick, I got to add one more thing. Back on the 1st of December last year, price of COMEX gold shoots up and closes at 2090. Clear breakout. Okay? Catching now every single all-time highs, every single short ever created is underwater. All-time highs here. So what happens? You get this massive chart painting exercise on Sunday the 3rd and Monday the 4th. Gold goes up 60, reverses 60, chases everybody back out. And it took 90 days for the banks to get right-footed, if you will. And then gold does break out on March the 1st. And now here we are, $300 higher. Silver broke out on May the 17th. With the actions that have taken since, it's probably going to take 90 days for the banks to manage their books, get everything in order, because they know the price has to go up with what's going on in Shanghai and its demand and everything else. But they need to buy themselves some time, and that's ultimately what this all boils down to. What happened here the week of the 20th of May.
Having said all these things, I mean, if we had to summarize it, when it happens again, because it surely looks like a when, how do you think it's going to pan out or play out? I mean, what are we going to see in the West? What are we going to see in the East? How are banks going to be doing?
Let's just say geopolitical events, BRIC events, whatever, keep that Shanghai price rising. And the COMEX tries to keep the paper price down. And for all the reasons that we discussed, arbitrage is really, really difficult to do. And at one point, I don't know, the People's Bank of China says, we will buy silver at $50. Or we'll buy gold at $5,000 an ounce. And now all of a sudden, there's no silver to back up these contracts anymore, and the pricing becomes irrelevant. Either the COMEX then is a price taker from the price that's being made someplace else, and either they catch up and they manage their books to try to play along and flow physical metal at this $50 price or this $3,000 price, or they just shut down. And there's precedent for that. There was something called the it was called Maine potato futures. I'm going back like to the 70s when I was a kid. But there was a Maine potato contract. And the big commercial was J.R. Simplot, the big Idaho potato producer. And he had, obviously, the contract was called Maine. I don't know if they produced, potatoes in Maine. I've never been to Maine. Anyway, one day it's just a delivery. The short couldn't deliver. And so what they do? They just closed it. So there's no potato futures on COMEX or the Chicago Board of Trade anymore. They just closed it. They settled all the contracts at the prior day's price, cashed everybody out, and just called it good. And there's no more contract anymore. And that's what would happen, on the day that, for example, like I said, on the day that, and I just use the Chinese as an example, but they say, in Shanghai, we are buyers of silver at $50 American. And the CME and the banks go, well, we can't. Then they would just say, well, we closed that day at $32.50, and we're just going to close everybody out at that level. Here's your check. The Fed backs them up, with a swap line. And it's just done. And the new price is whatever. Like I said, there's precedent. Anybody can Google Maine potato futures if they want. God, I must just be old as dirt to remember all this crap now, Patrick. Jeez. But there is precedent. So I'd encourage everybody to research that if they're interested.
No, you're not as old as dirt, but you are definitely well rooted. You know these markets perfectly well. I'm just kind of wondering here. Let's say the price for silver. Let's just say it gets to a point where it's set in the East. Could it be possible where in the West may just reject that price and still try to operate on a different price? And then how would things then work?
That's the physical delivery component in the West that we can all impact. Because, it's like now. You're basically, the COMEX price, they might as well just be trading baseball cards. You have to be able to deliver physical metal at the price that you discover through the trading of the derivatives. Because if you don't, then your derivative is just whatever. Why not have the derivative be $12 an ounce for silver? Because you have to deliver metal at $12. Otherwise, make it $6. It's just irrelevant. It just doesn't matter anymore. Because you can, for the same thing, you can sell your, sell your silver that you have for $50 or whatever someplace else. So the COMEX and the LBMA have to keep pace. They don't have any choice. And if they don't have the physical metal to deliver, and that's why this is all so important. That's why this copper story is so important. If there's not physical metal to deliver at that price, then that derivative price just doesn't matter anymore. It just doesn't. And again, think of this. I'm just going to go back to the copper thing for a second because it's so hilarious. You get these stories written on Bloomberg by somebody who was a humanities major at some Northeastern liberal arts college. He doesn't know any of this crap. Right? Well, Trafigura might have to have some copper ore sent to New Orleans. They don't even. Anyway, go to the CME website. You can see all this for yourself. There are 6 international vaults that back up, or national vaults, let's put it that way, that back up the COMEX. They contain about 20,000. Most of it's in New Orleans. About 12,000 tons are in New Orleans. They're not even in New York. Okay. And it's not like the COMEX copper market's this big, huge thing. But if it can't deliver at this whatever price they're foisting on people, then that price is irrelevant. It's not irrelevant today, but it's definitely going in that direction. And so that's why, again, if people want to have an impact and they're tired of this, they're sick and tired of the games, capping price at 2 a.m. U.S. time and rolling out CME margin hikes to tamp things down. If you're sick and tired of that, and like me, you've been sick and tired of it now for over a decade, the only role we can play is to continue to buy physical metal and take it out of the system. That's all you can do. Gold and silver. And at some point, they won't have metal deliver, and then it'll just be over. I mean, it hasn't always been this way. They developed and started COMEX futures trading on January 1, December 31, 1974. Coincidentally, Americans were able to own physical gold again after 40 years on January 1, 1975. I'm sure that's just a coincidence, Patrick. I'm sure that wasn't planned. But nonetheless, that's how it's been for 50 years. And just because it's been that way for 50 years doesn't mean it's going to be that way for another 50.
I think plan is definitely the right word, because before that happened, we also had that London gold pool going on where plans for prices were happening. So I will hang on to my silver. I will hang on to my copper. It's a bit tarnished here. But okay, so I guess silver just has to go through this phase of shenanigans, and then we'll see better things ahead.
I'd invite everybody to pull up a chart, a daily chart of gold. And if you just go back 6 months, you can still get to the 1st of December when gold broke out. And then it had that ugly candle on the 3rd and the 4th and pulled back for about 2 weeks and then went up again at the end of December into the, all the bullishness of 8 rate cuts and all that kind of, we knew was never going to happen. Anyway, and double topped. And then in January and February, for about 6-7 weeks, as rate cut expectations changed and the dollar rallied, it just kind of grinded lower like this. And that was the banks, in my view, getting themselves positioned for what they knew was going to ultimately be the breakout. And then it came on March the 1st when Fed Goon Waller said, hey, there's room for more new QE here. And we shot up $30 on a Friday, March the 1st, and broke out and off the races from there. The same thing now has happened in silver. They've painted a double top. I'm sorry, the false breakout. And now it's going to pull back, and it's probably headed back down below 30 and 29, and probably going to be there while the dollar rallies over the next 6 or 8 weeks and into the summertime. And then we'll see what happens once they're ready. And then the next target is 34, 36. It's not 50 or 70 or something like that. We'll go to 34 or 36. All the speculators be long again like they were, a few days ago. and then the price will get capped, and then it'll pull back to 32. That's how it'll go. But most likely, outside of some geopolitical event or the Shanghai price just continuing to rise, that's probably how it's going to trade here for the next few weeks now that the chart has been painted as efficiently as it has.
Yeah, definitely agree. Even with these, how you mentioned the political events, I mean, we're seeing them all over the world, no matter where you're at. I mean,
Yeah.
we're seeing it, so definitely something to keep an eye on there. But Craig
Yes.
Hemke, before we head out, can you let us know how we can follow you and see more of your work and services?
Well, I try to share some stuff on Twitter. There's like 67, and they're like actual, like I go through there once in a while. It's not like robots. I've got 67,000 followers on Twitter, which is like so crazy. They're like I'm talking to a football stadium, you know? Because it says right here, dope with a MacBook. That's all I am. I'm just this guy that spends way too much time over the last 15 years watching this stuff. But you can follow me on Twitter at TF Metals. So that's pretty easy. But I mean, crying out loud, if you really want to know what's going on around the world, and it's not just me, it's from the people on my site for 15 US dollars a month, 50 cents a day, you can join TF Metals Report. It's tfmetalsreport.com. I write a post every morning that's not just here's what the charts are and we're looking for a swing and a pivot low. No, I mean, if you're going to follow gold, I mean, it's geopolitics, it's politics, it's economics, it's monetary policy. Your morning update is all of that stuff. And then I record a podcast every afternoon just in case you'd rather listen instead. And you get all that for $15 a month. And like I said, access to a community that, well, let me give you one more thing. Last weekend, after that May the 17th, I had recorded a podcast the day before with Dave Kranzler of Investment Research Dynamics, and it was an open thread. So it is still worth listening to. So if you want a sense of how the community works, go to tfmetalsreport.com, scroll down, you'll find a link to that discussion with Dave, and it's a public link. And then just start scrolling through the comments. It's not just people flaming each other, calling each other names, and like Zero Hedge or, all these other whatever sites. It's people helping each other. And so scroll through there and you'll see what the thing's all about. And I think, boy, at a time like this, you need all the help you can get. And that's what TF Metals Report is. God, I must have had too much coffee, Patrick. I'm just sorry.
No, it's great. That's exactly what the good people want. They want to hear what you have to say. That open thread is Kranzler chasing you with a tennis racket, and you're gonna go back at him with the golf club or something. What's going on there?
Yeah, something like that. It was a lively discussion. Toward the end, I've known Dave for so long.
Yeah.
He referred mining stocks as popcorn that they just start popping. So toward the end, I renamed him the Orville Redenbacher of the mining industry. And I thought, well, that wasn't something I was planning on saying today. I don't even know where that came from. But now, henceforth, going forward, he's no longer Denver Dave. He's Orv.
Oh, no.
And anyway, it gives you some idea how we roll. We don't take it too. If we took this crap seriously, I mean, I'd have been suicidal years ago. You have to take it with some measure of irreverence. But it's serious business. And combine all that into one where the dope with a MacBook does his work.
All right, Craig, I want to thank you for your time. Of course, your insight and the way you explained it all to help us understand, because gold and silver are more than just price. So I thank you again for helping us understand it, and I hope we can do this again soon.
Anytime you want, Patrick. So it's good to see you, my friend.
That was Craig Hemke sharing his views on copper and silver. To see more of Craig's views and work, please go to www.tfmetalsreport.com. If you like this video, please do subscribe, give it a thumbs up, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.